As coronavirus continues to grip equities markets, analysts are paying close attention to company guidance for the clues on how this health scare could impact business. But why would companies issue forecasts with so much uncertainty, especially now? It's time for Yahoo U, and Brian Cheung is here to break down earnings guidance. Brian?
Well, Adam, the coronavirus has earnings guidance increasingly in focus, and analysts want to know how may the virus impact companies, and companies are already talking about it on their earnings calls. So FactSet actually analyzed the S&P 500 companies that have reported so far, counting 47 companies that have mentioned the coronavirus, saying it's too early to judge the impact. 34 other companies said the guidance was already baked into their coronavirus impacts. Now, this number is likely larger now since the FactSet analysis actually only had companies that had reported through February 14th, which at the time only covered 364 firms in the S&P 500. But the question is, how might companies issue guidance if they wanted to message to investors that there may be an impact of shocks like the coronavirus? Well, let's use my made-up company as an example. So if you open up a slide deck for a company earnings call, you might see something like this. So I'm Cheung Shoes, I manufacture shoes, and I'm forecasting that there will be impacts on my future earnings because of the coronavirus and also weaker demand in China. So I'll include revenue guidance based on how my financial analysis team assesses the impacts of those factors on my business. So in this case, I've got projected top-line revenue for Q1 2020, and I also have full year 2020 numbers here. But it doesn't just have to be top-line revenue. Keep in mind that companies can guide on net income, they can guide on earnings per share, even expenses that management might expect during that time. And of course, always there's that boilerplate language that we're still positioned for success, blah, blah, blah. But this raises the question, though, why would I issue guidance in the first place, especially with something as uncertain and unpredictable as, let's say, for example, a virus outbreak? Well, it's because you're somewhat protected. So if you actually phone into any earnings call or read any earnings slide deck, you'll see something like this, some information provided, and I'm not going to read the whole thing. But the translation here is that these forecasts could all be wrong. And we can't be held responsible for this at Cheung Shoes. Actually, under U.S. securities law, it's important to note that there's no requirement at all for companies to issue guidance at all, hence why these legal disclaimers. So the reason why companies would issue guidance is because it sets expectations over different time frames, short term and in the long term. So investors may be watching the stock price day to day, which can cloud company plans for the medium or the long term. It actually might be in a company's best interest to let them know what they expect to see in a year or so, as Cheung Shoes did, for example. Companies actually they'll have these investor days where they'll provide 5 to 10-year plans. And in the case of the coronavirus and headline risks, it also baselines expectations on how exposed the company might be to a sudden shock. Both of these points, giving investors a heads up and setting expectations, are critical for analysts that create their own forecasts, which can align in some cases or differ in other cases with what the company is guiding on. And lastly, it can actually create a performance incentive for the company. So if you set lofty goals, you may be forced to actually hold yourself accountable to hitting those targets. But one problem with earnings guidance is that companies can set, well, a low bar. So the distribution of companies reporting guidance is a bit lopsided. This is data from S&P Global Market Intelligence, and it shows that well over half of S&P 500 companies that provide guidance beat or meet their own earnings guidance. And this data, for what it's worth, is actually only as of the first quarter of last year, but the 5 quarters here that I'm showing you still covers a period of time where there was considerable uncertainty over Fed policy and the Trump administration's tariff threats. Now, President Trump has actually expressed interest in killing earnings guidance, tweeting in 2018 that he would like to, quote, stop quarterly reporting after chatting with some of the world's top business leaders. He may have misrepresented those conversations, though, because he was probably referring to Berkshire's Warren Buffett and JP Morgan's Jamie Dimon, who have argued that companies should not be expected to provide guidance each quarter, not necessarily the actual act of reporting quarterly results. And their argument is that it adds noise and it can hurt companies if they miss forecasts that were hard to build in the first place. So guys, the natural question here is therefore, how helpful is company guidance, and does it actually provide useful information to the public, especially in as uncertain times with as much uncertainty with events that you can't predict, like the coronavirus? Something worth watching as more companies continue to report through this season.
All right. Brian Cheung, thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.